everybody, and welcome to our channel. Today I have with me Wei Wei Chua from Mirae Asset Management. Wei Wei is a specialist for Chinese equity and a senior investment analyst. Welcome, Wei Wei.
Hi, thanks, Thomas. Thank you for having me.
So, Wei Wei, we've seen a lot of movements in international stock markets. We have seen this breakdown in February. How have Chinese stock markets performed since the outbreak of the COVID-19 virus?
Yep. So it's been a roller coaster, I would say. So at first, the MSCI China corrected around 10% when the stock market reopened after the Chinese New Year holiday. Investors were digesting the seriousness of COVID-19 and how much impact it would have on the Chinese economy. The market then recovered slowly as the investors kind of gained more confidence that the government had the situation under control. And then the government also injected huge liquidity into the A-share market. So at that time, we also thought that the A-share market would be kind of decoupled from the global markets. But then it tumbled together with the US markets and the other global markets when we saw huge global de-risking. And this was mainly due to the spread of the virus to the US and Europe, as well as the collapse in oil prices due to the disagreement between Saudi Arabia and Russia.
Okay. So currently we hear very diverse news from China. On the one side, we hear production is raising again, workers are returning into the factories. On the other side, so there's a new travel ban, so foreigners are not allowed to enter China anymore. So how long, from your perspective, will it take China to get back to normality?
Yeah, that's a very good question. I think it's difficult at this point to predict the exact time frame, given the fluidity of the situation and the global nature of the whole pandemic. However, we do believe that China is actually recovering faster than the rest of the world. You can see high work rate resumption in most of the provinces right now. So I think industry leaders will find it easier to cope with the increased social distancing measures simply because they have better facilities for quarantine measures, and they're able to move workers who are actually sick or something to other locations at this point compared to the smaller companies. The ban on foreigners would be actually China wanting to prevent a second wave of imported cases. So I think it will take some time for tourism to recover. If we look at some data, the big three airlines in China, they recently showed us some of their data. And we estimate that for domestic flight volumes, they're around 40% of what they used to be last year. And for international flights, it's about 10%. So we can see that for the domestic market, it's kind of coming back, but for international travel, it still remains very weak.
So you're an equity analyst. I was wondering, did you already calculate how much the impact will be on your portfolio companies for their growth and of course for their midterm, long-term valuation?
Again, that's a very good question. I think it's also a very tough question for us. I think at this point, it really depends on our base case as to how long we see this pandemic going on. And also it depends on the sectors that we look at. So if we think that the virus, in our bull case, that if the virus recedes by the middle of this year, we possibly could see a V-shaped recovery. And if there's also coordinated stimulus policies by global governments. However, in the bear case, we think that the virus might continue to linger and we might get a second wave like what we're seeing in Hong Kong and in the rest of Asia right now. And in that case, it will make social distancing more common. And that will mean it takes longer for us to resume to normality. So it might take the rest of the year for companies to recover. So in that case, I think the biggest impact would be on restaurants, offline retail, and travel. but I would say at this point, it's at least 1 to 3 quarters worth of earnings for most companies.
Okay. So how about the private consumption in China? So do you think consumption is more kind of postponed for maybe some quarters, or is this lost revenues for the companies?
I think there is some pent-up demand definitely from the consumer, but at this point, I think that consumers would be reluctant to spend heavily on discretionary items in the near term, even if the government does various tax cuts, because I think the consumption appetite is just not there if the virus is still going on. However, I think some positive news coming out from China recently. We did see that travel-related demand is coming back, especially just across the recent Qingming festival holidays. So whether this recovery is sustainable, we really think it depends on the second or third wave of the virus and whether social distancing rules are relaxed. And again, it would be very difficult to tell. So I think at this point, it's all very fluid. But we definitely see that the consumer has the intent to spend if they are confident of the future.
Okay. So which industries in China will emerge first from the crisis?
So we think China will do a mixture of old and infra related spends. So I think they would actually issue special municipal bonds for infra spending on railways, metros, data centers, and even 5G base stations. So recent commentary when we spoke to Chinese infra construction contractors, they saw good order book visibility for 2020 and more than 90% of work resumption in their factories. And we also noticed that they have stricter oversight right now for leakages into non-infra projects. So the government is really watching that the amount of money that they spend is not going into other things like land banking. So construction-related names we like, even some of the cement companies at this point. With the second wave of infections and right now rising unemployment rates in China, so it was 6.2% in February, an all-time high, and the consumer sentiment is still rather fragile. We think that the government spending and SOE mandated work resumption would produce an immediate impact on the GDP rather than consumption-led recovery at this point.
Okay. So the Chinese government so far has held back in terms of fiscal stimulus. So especially if you compare it to the activities of governments in Europe, in the US, or in Japan, the latest with their huge programs. So what can we expect here from the Chinese government? Will we see more impulses there?
Yeah, so I think you're right. The Chinese government is slightly behind the curve at this point. So far, the government has front-loaded municipal bond quotas. That's about RMB 1.8 trillion. We have seen relending support to SMEs, social security expense reliefs. And we think that the fiscal deficit could be raised further with more help provided for small businesses and to expand low-cost financing channels. So special purpose bonds, that could be upside. We think it could reach 3 trillion RMB this year compared to 2 trillion last year. The final amount would be dependent on the upcoming NPC meeting. And special treasury bonds could be announced earlier as it only requires approval from the NPC Standing Committee. These fiscal measures that we see right now will be complemented by other easing monetary policies such as triple R cuts, LPR cuts, and MLF cuts. So I would say that it's a combination of both fiscal and monetary policy. The Chinese government is slightly behind other economies, but I think we're going to see things very soon.
So when we have a look at your portfolio that you're running, so how did you navigate this portfolio through that up and down during the last 3 months?
Yeah, it's been very volatile and it's been quite tough. So basically, we reduce our positions in companies that are seeing first order direct impact from the virus, such as restaurants, duty-free, airports, and retail. The portfolio right now is positioned in e-commerce, online education, cloud, pharma, telemedicine, and infrastructure plays. So we believe that companies focused on domestic demand will recover first. Export-related names will be under pressure in the near term because of the impact to demand and supply chains globally. So like for example, we see the rise of global champions in China, as well as more localization in the products. So I think that right now what we have in the portfolio is pretty defensive. So it's more domestically focused. And with that, as and when the global economy starts to recover, we can start to add more names that will be more exposed to the global supply chain.
How about the large Chinese internet stocks like Alibaba and Tencent? So how did their stock prices react during the crisis?
So I would say that the share prices reacted along with the market. They corrected most of it together with the market.
Yeah.
I think Tencent performed relatively better because it's online games mostly.
Yeah.
So people will expect, okay, if you stay at home, you would play more games. They have e-payments as well. So most of it is positive. For Alibaba, they were able to deliver, but at the same time, as I said before, the bottleneck was the delivery service.
Yeah.
And at the same time, I think people cut down on spending on discretionary items. So there were more spending on maybe basic necessities, but there was a reduction in spending on discretionary items. So net, I think they did see a decline in January and February, but that's also during Chinese New Year. So at that time, seasonally is supposed to be a weak quarter as well.
So sorry.
Go ahead. Yeah. So in terms of the recovery, I think Tencent has done a little bit better because everything is online.
Yeah.
Alibaba, you still need the physical person to go deliver the items for you. And also Tencent over the last 1 or 2 years has been impacted by games licensing issues and the government wanting to clamp down on like people playing too many games. It's just like they say, okay, children shouldn't play so much games, which is also true. To a certain extent, right? So that kind of impacted the sentiment on the stock for the last year. Yeah.
So are you overweighted in those internet stocks, or what is your position when it comes to Tencent, Alibaba?
So I think to be honest, for the internet, like the two big guys, Alibaba and Tencent, we are close to 10%, and that's partly because in the benchmark, it's also around 10% or more.
Yeah.
So we can only buy up to 10%, so we have no choice. So in that sense, I think we can't really take a view on whether we want to be overweight on these guys because we can only buy up to 10%. In terms of education, online education, we like that sector. We think that, from this online to offline migration, they're going to do very well. But recently, actually last night, I'm not sure if you heard, 2 nights ago, Luckin Coffee, one of the biggest coffee chains in China, that one blew up. That was the competitor to Starbucks. And then yesterday, after the market closed, TAL, which is the largest after-school tutoring service in China, mentioned that they found one employee who was engaged in fraudulent accounting. So we have positions in TAL. The magnitude is very small, but obviously this is more like a corporate governance issue. And I do know that a lot of funds are also invested in after-school tutoring stocks. Yeah. So we need to watch this more. We need to watch this closely and see what happens. But I think the magnitude on the earnings will be small, but obviously investor confidence would get impacted. But still, I think this sector is definitely one of the key drivers that we see in the portfolio, because right now the top 2 players only have 4 to 5% market share for tutoring.
This was Wei Wei Chua from Mirae Asset Management. Thank you very much, Wei Wei, for sharing your insights with us today.
Thanks, Thomas. Thank you.